the Grey DFS. We were sceptical this morning because they come out with, they were in a trading halt for a capital raise.
Mate, the alarm bells were going off.
But the DFS dropped about an hour and a bit later.
If we're looking at the cash flows now, there's an extra $300 an ounce. That gives you an extra roughly 1.7 billion in extra revenue. Your capex bill has gone up 300 billion. All in sustaining, it's gone up an extra Aussie $21 an ounce, which is worth about $120 million. Extra tax on that, 475 odd mil. And that leaves you with about $800 million in cash flows. But the DFS only shows there's only an extra $400 million in pre-tax cash flow. So where's this other $400 million going to?
Righto, Money Miners, Thursday, 28th of September. Mate, I'm absolutely bloody cooked after this. 2 PFSs and studies to go through today.
A big one.
Oh, Jesus Christ.
Now we actually have to talk about them, mate.
I know, and we've got our newest employee joining the table today, Ali GC. Welcome to your first interview as an employee
as
of Money
an
and Mine.
It's been great.
Oh, send bloody sation. Right, today we're getting into Latin. We've got the Latin economic assessment. We've got the Grey DFS that's come out, and then a bit of quick fire at the end. But those first two, quick fire about 29 metals, MinRes and Gina, Liontown. But the bulk of it's going to be Latin and de Grey.
Awesome.
Exciting stuff.
Looking forward to ripping in.
Oh, mate, can't bloody wait. Sponsors for today, our great friends at JP Search. Ali, you bloody, they're spewing with...
Sorry, guys.
They're spewing with pinched you. Describe yourself and I guess why JP Search would place you somewhere.
Oh, I had a great chat with Xavier, actually. He had all the ideas, all the connections, and really anything you needed to get placed in the finance industry. But Money and Mine just happened to jump in first. So
Were you close?
Close. Very close.
Sorry, boys, but hey, Ali won't be the last one we fought on. So if you're looking for a new finance gig and you're in that world, CFOs are preferable because they clip a bigger ticket. But get in touch with Xavier and Michael at JP Search. Great friends.
Awesome. Cheers, JP Search. Alrighty, guys.
Right, let's rip in the Grey DFS. JD, mate, we were sceptical this morning because they come out with, they were in a trading halt for a capital raise right at the end of the quarter when the DFS was due, but thank God.
Mate, the alarm bells were going off.
Ringing red flags, the smell test, everything was fucking going off in the office. We've got sensors when JD has a heightened level of anxiety, but the DFS dropped about an hour and a bit later.
That's it. So sort of running a capital raising concurrent to the DFS coming out. So a bunch of info, hundreds of pages. As usual, we've gone through it and we've got to disclose first up. Ali GC is a shareholder. Ding, 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 ding.
I love it how he got the...
He picked up the notes you put down.
He'll love it. Okay, so for people that don't know, de Grey have is it the Molina, isn't it?
I think they're calling it the Hemi Gold Project.
Yeah.
Oh, they're just calling it the Hemi one.
Molina's the regional, but this study is purely focused on Hemi.
We've got fucking Molina, Salina, Colina today because we've got Latin too. So, okay, the Hemi Gold Project, it's up near Port Hedland. It's absolutely bloody massive, this thing. So
from the PFS, they've stripped out the regional parts. So this is Hemi only. They are going to be recovering 5.7 million ounces. So it's bloody huge. The gold
500,000 ounces a year. So she's one of the bigger discoveries in recent times in Australia.
That's it. So mine life of 12 years. That's down slightly from the previous study, the PFS, which had 13.6 years. Strip ratios jumped up from 6.1 to 6.6. Ore reserves have moved up from 5.1 million ounces to 6 million ounces. Now, starting to get into the juicy stuff, what really matters. The NPV, using a discount rate of 5%, is up to 2.9 billion from a previous number of 2.7 billion. We flagged when we spoke about it a couple of weeks ago. I don't know how the company justifies using a 5% discount rate. Ali, you've been deep in this world for a long time. I mean, the cash rate's at a bit over 4%.
Yeah, no, if you've got a cash rate of 4.1, I just don't see how you could be using a discount rate of 5% in this market. I would have thought something like around that 7% would have been more appropriate in the current environment. And mind you, while de Grey is Hemi is an amazing ore body, It's not exactly an easy and uncomplicated project. You know, it's a mammoth of a thing. So you got to have, I think, a bit more than 0.9% risk in that discount rate, I would have thought.
Yeah, like the risk to achieve a 10 million tonne run rate in with the ramp up risk, especially when you've got pressure oxidation and, you know, 0.1 of a gram is a lot of money at this, so whether it reconciles. So there is a bit of risk when it's this big and a bit lower grade and refractory.
Yeah.
So, and
mind you, De Grey is not the only company that we've had this bone to pick with. So the IRR is actually down from 41% to 36%. And you look at the payback period, that stayed the same at 1.8 years. And the way they've managed that is they've sort of rejigged the mine plan slightly. Brolga, which is a sort of higher margin part of the mine plan, is going to be done first up. Hence, you get those cash flows sooner. So the payback period stays the same. There's a few other.
We'll put a picture up. Like, it's pretty much 5 big pits.
Yeah.
For the mine plan. It's not one big pit. It's like 5. So there's fucking gold everywhere.
Yeah, and there's a few other aspects that obviously play into that payback period staying 1.8 years, which we'll get into as well. But strategically, it makes sense that they target that higher margin aspect, that part of the mine plan, to get those cash flows in early to keep that payback period down. So the CapEx, this is the big one. 1.05 billion is what it previously was. That was from the study from the PFS, which was done about a year ago, September 2022. It's now 1.35 billion, so up 28% in 1 year. So not entirely unexpected. You can't really hold the company to that. That's the environment we are in at the moment. Gold price assumption, that's jumped from 2,400 Aussie dollars per ounce to 2,700 dollars per ounce. So, Ali, you had a look at what a few of the competitors done. What did you sort of pull up?
Yeah, so I had a look at the Super Pit expansion, had a look that Northern Star's doing, and Ramelius's Edna May Stage 3 open pit study from earlier this year, and Westgold's Great Fingal study as well, and they all use 2,600 Aussie gold price flat. De Grey's using 2,700. I would say it's probably about right.
Yeah. And the company, they sort of backed that by saying that the gold price when that initial study was done was 2,500, and now they quote 2,950. So let's get into cost now. The life of mine all-in sustaining cost is up 21 Aussie dollars an ounce to 1,337. So that is more or less
flat.
It's more or less flat. Maddie, you had a little look at what the mining costs have done. Not a massive change either, right?
Well, I think we're asking, as you said, the CapEx has jumped by 30% due to labour inflationary reasons, as per which is commonly known. But you look at the mining costs per tonne of ore processed, that's up $6. The grade since the PFS is down 0.1 grams. The strip ratio has gone up from 6.1 to 6.6. And I guess I'm just probably seeking some clarification of how the all-in sustaining can stay pretty flat, or maybe those factors aren't as influential over a 10 million tonne operation, but I thought they might be. Look, what do you guys think?
Probably a bit more of a rhetorical question back at you guys, but I'm not quite sure how the company's managed to maintain flat costs on a mining basis, on a processing basis, whilst they've experienced the cost inflation that we've seen throughout the industry, equated in the 28% jump. So I don't have any real clarification for you there, Maddie, but I'm sort of fascinated how the company's managed to do that.
Ali GC, you might be able to delve in.
Yeah.
You've played with spreadsheets your entire life in the IB world. What was your first takeaway?
No, my first takeaway is I wasn't sure how it sort of looks like the CapEx has experienced the impacts of that cost inflation environment, but we haven't really seen the same in the OPEX, and it's just sort of, I'd be interested to find out some more about it, or why. It doesn't appear to be immediately obvious to me.
Mm.
So why don't we get into our sort of takeaways and what the summary of the DFS is overall?
Yeah, I think the main thing is, all right, they've moved the gold price up $300 an ounce in line with the current, pricing, which I think is pretty fair. But they've kept the discount rate at 5%, which is where they previously had it at with the PFS. And I think they may have done that to sort of, help the MPV still look a bit better with the higher capex bill. But if you did run that model at a 7% discount rate, which in my opinion would probably be more appropriate in this current environment, you'd probably be looking at an MPV that is equivalent or less than what the PFS was.
Definitely agreed on that point.
So if you look at, if we're looking at the cash flows now, so we know there's an extra $300 an ounce added to the gold price assumption, so $2,700 an ounce compared to the PFS. That gives you an extra roughly $1.7 billion in extra revenue. Then your capex bill has gone up $300 billion. Your all-in sustaining has gone up an extra Aussie $21 an ounce, which is worth about $120 million, plus some extra tax on that. So assuming a 30% tax rate, that's about 475 odd mil. And that leaves you with about $800 million in cash flows. But the DFS only shows, and I think we might put up a bit of a table here, that the extra $400 million, there's only an extra $400 million in pre-tax cash flow. So where's this other $400 million going to? Is it growth capex? Is it exploration? I'm really not sure. I was just struggling to find where that's going towards.
And I guess the point I had before about the increase in the mining cost, because that an extra $6 a tonne over the life of mine of ore process at 10 million tonne a year, that's what, 720 million, but you're going off that extra $21 an ounce of all-in sustaining. I think it's leaning towards it.
Mining,
it feels like that all-in sustaining should be a bit higher, which whether that would account for that 400 million, or is that 400 million going towards cutbacks, which as growth capital but not being included as sustaining capital? Oh yeah, who knows?
Don't know.
It'd be good to get the answer. De Grey, get in touch. It's more out of curiosity. It's just numbers, but far out. It's bloody mind-boggled us, the Savi, hasn't it?
Yes.
Maddie, you had to dive into the capital costs. What we really want to get into is, this is a pressure oxidation circuit. It's relatively unique in Australia. There's not too many, especially at a scale like this, that have done it. And you did a bit of a thumbsuck analysis on whether the assumptions and the numbers they've put forward are, reasonable, I guess.
Well, they've allocated $1.3 billion for the total project. Let's say $1.1 billion of that's for the processing side. Remember, you've got camps, you've got workshops, you've got offices, you've got bloody shitloads of stuff. And with that, they're proposing to build a 10 million tonne per annum crushing, grinding, flotation circuit, then an 800,000 tonne POX circuit. That's the pressure oxidation to deal with the refractory component. Then you got 8 cyanide leach tanks and every other bit in the middle, plus all the other processing infrastructure. And you can see it by the big processing flow sheet that you won't be able to probably zoom in enough to find any info on anyway. But Northern Star quoted $1.5 billion to expand their KCGM operation by 14 million tonne capacity. They've probably got a lot of infrastructure already in place. They do include a new ultra-fine grinding circuit, but they don't have any POX circuits. And from what I've been told, the POX circuits can be a considerable part of the cost of what a total milling circuit is, the POX component.
Don't come cheap.
No. So, look, eyes will be on the future if they can, build a 10 million tonne POX plant for just over $1 billion.
And the company...
If they even build it somewhere, we'll get to that bit later. So,
yeah, and the company flags a plus or minus 15% accuracy on these numbers, sort of DFS standard. So let's get into the raising. $300 million, tranche 1, $246 million, and the remaining 54 will need shareholder approval, which should come through in November. Gold Road, they are the major shareholders in De Grey prior, and they're taking themselves up to 19.9%. So that is $65 million of the raise, quite a big chunk, and they had from the last cash balance that we saw, $157 million, so they should be able to cover that, no worries.
So they're maintaining their 19.9, aren't they?
That's
they were
right.
19.9 before, yeah.
Yeah, that's right. So the share price they're doing that at is interesting. The company is trading, or when they last traded yesterday, at a year-to-date low. So they've been trading well over $1.30, over $1.40, touching $1.60 earlier this year. much to your dismay as a
Yes.
shareholder, Ali, they went into halt at $1.11 and they're raising at $1.05. So that's a bit of a hit to have to do it at such a price. The price just took a big dive. Can't really explain why. No real announcements aside from the annual report that came out 2 weeks ago, but it's just trailed off a bit.
What's the use of funds they're saying for this 300 million?
The use of funds is interesting, Maddie, and there's a bit of a gripe that I've got, and it's not exclusive to De Grey here. So general working capital and placement costs is the big ticket item, $146 million.
You want a bit more.
You need more detail on that. If that's almost
that's bigger than most companies' market cap.
Yeah,
You need more
it's
detail.
50% of the actual placement size.
Yeah.
In one line item.
And companies should start to break out what the placement costs are. It's just
Maybe they don't know yet, but they'd like the cash in the bank to make a decision.
You're not really going to spend that much money without knowing. $54 million is going to exploration, which is kind of interesting given where they are in their life cycles. So, I mean, looking at the classic Lassonde curve, they're starting to hit that top of the first cycle. They've had all the excitement from exploration. They've discovered a world-class asset, and now they're getting to the real stuff. They have to build it and turn this into a business that makes money. So
I think they've actually gone past that. Like, as you said, by the share price decline, they've probably gone past that point now.
yeah, they're starting to get into the real stuff. The DFS and the construction period is when there's, a lot more potential downside than potential upside. So the way I see that exploration budget is to maintain some sort of upside, but it is kind of interesting that they allocate because, $54 million, it's not an insignificant amount of money.
No, well, you look at that's pretty much what Spartans their funding was after that's how much their money they had in the bank to, fund a full year of exploration to prove up that ore body. So is this going to be, it's a lot of money.
Yeah, and when you look at it, like materially, what are the changes going to be? Unless they discover something else that is just ginormous that completely changes it, it's only going to change it's going to add years at the back end, which you're not going to see the cash flows for a long time. Or if they're, if they're at depth, you're still not going to see those cash flows for a long time. So
at least even if it's like for the purpose of exploring deeper to, I guess, prove up a underground mining option that could occur concurrently with the pit, that'd be still years away. Like at least if you're going to prove up something that big to do with it, that could be 3 years away. But I guess are they going to use that deeper drilling? Like they did say that there's been minimal drilling below 400 metres RL, and the base of the pits are going down to 390. So are they going to explore deeper to prove a bit more up, to dress it up for someone else that might come along,
Potentially.
that might fit the funding and fit the the bigger player job.
the sort of risk profile with
we'll get to the
thing of this scale.
Hold on for the speculation later, money miners. We love it. Right, do you reckon this is the last raise, guys?
No.
Ali, you did a bit more analysis than just no up front.
Nah, next.
That's it. So, all right, if you look at the CapEx bill, $1.35 billion, you obviously need working capital and money between now and actually constructing this thing. So
I think they're pretty set there based on the 150 they're allocating to it.
So say another 150 of working capital, let's call it $1.5 billion. The investor presentation released today by De Grey indicated that based on the PFS, they've got an approximate $800 million debt funding capacity that's been sort of indicated to them by prospective financiers. So let's roll with that as a thumbs up.
But has that been updated for this, or that was based on the PFS?
That was based on the PFS, so that'll probably have some revisions with the new outcomes from the DFS.
So that has the potential to get bigger.
Potential to get bigger or smaller, yep.
Yep.
They've recently raised the $300 million equity, and they've got about $84 million in cash at the moment, of which arguably some of that will certainly go to that CapEx bill with long lead items and early works and things like that. So, but by the time you do the calcs, there's still another, say, $400 to $500 million required to cover the CapEx bill and some assumed working capital to get to construction. So Is it going to be a royalty? Is it going to be a stream? Is it going to be another capital raising or, a combination of all three?
A lot of investment bankers' ears will be pricking up now. There's a big raising to come in the future. I think if there's any possibility they sell the thing, which I'm sure we'll get into in predictions, they wouldn't want to put a royalty on it because a prospective buyer in the future would be livid because that royalty doesn't go away when the owner of the asset changes. So I can't imagine they'd go down that route, although maybe they'll surprise us.
Unless they pay the royalty out.
Yeah.
That'd suck.
All right, let's get into a couple predictions.
Well, I think we've come to the establishment. It's a fucking unbelievable deposit. It's going to be a great mine. I want to know what you think.
Little doubt that
who's going to do it.
Yeah, little doubt that it's going to be a mine, right? That's seems to be a foregone conclusion here. Who's going to mine it though?
What do you reckon, JD? What's your things? What's your thoughts on a big 10 million tonne operation and a company like this doing it themselves? Likely or unlikely?
I'll have a punt and say, sure, let's say in 3 years' time, who's going to be the owner of it? I'll have a guess, Barrick.
Barrick. Ali GC, what do you reckon? Always like to leave myself last. So
I don't have
some of your ideas.
I don't have much backing. That's just a real guess.
Barrick was kind of my one as well. You do have your other guys like, Newcrest is kind of gone, so that's
Hey, that's my table you're looking at there.
But it's just it's in my mind it's most certainly not De Grey to be operating an operation of this scale and nature. You need someone who's done it before.
So what's your guess?
I'm going to say Barrick as well. Sorry, JD.
And I think looking at, and this was in the DFS, the other companies that have operated successfully applied pressure oxidation to their mine sites. And yeah, look, we've got a refractory episode coming out next week with Refractory Rob, or Preg Rob, we call him. And it just like, refractory ore bodies are not a common thing, but you look at this list here and some of the key players like Barrick and Newmont have a lot of experience in it by the looks. And look, with the Newcrest thing merging, it reeks of one of those big players taking this on. Like you can talk about the Australian-based ones, Northern Star and Evolution. Look, Evolution do have Red Lake, as you can see there, but would they want to take the risk of you'd have to pay $3 billion to take over the company. You then got to put in 1.3 could blow out to $2 billion capex to then build it. So that's a
lot of money,
big commitment. And would they want to take the risk on the pressure oxidation? Looks like it's in the hand of either a Barrick or a Newmont.
So you have to say Newmont.
I'll just say Newmont.
Yeah.
I'll just say Newmont, just due to the flow with the Newcrest merger, and especially if
we can't all pick the same thing.
Especially if some Newcrest, some assets come out the arse end of that, like if Telfer comes out and gives them a bit of cash. Not that it's probably insignificant to Newmont, but I think they might look to make a play. I'll go Newmont.
Awesome.
Jeez, that was fucking long-winded. Sorry, guys.
Let's rip into Latin Resources. So they came out with a preliminary economic assessment. In their words, robust.
Robust.
We'll be the judge of that.
Mate, it wasn't, I won't give it away early what we think. But look, for the money miners, they've got the Colina lithium project in Brazil. So they've got a mineral resource.
So that's hard rock.
Hard rock, spod. The guy with the rock wins, Mr. Ellison reckons. 45 million tonne at 1.3% lith. It's 80 Ks away from Sigma Lithium's Grota. Oh, fuck, can you say that, JD?
Grota do Cirilo.
I wouldn't have even gotten close.
So we had a chat about them putting themselves up for sale.
Yeah, so that's now in production. So what was the go there? What happened there again?
Pretty much put themselves up for sale. They are big TSX listed asset who said they've attracted bids and they're going to make a decision by the end of the year.
Oh, there you go. Yeah, I forgot about that. No, we have talked about that. So, okay. While Latin have been approaching this maiden study, they've had a real good share price run up to about 42 cents, but in the last 2 months they've really retreated. So they're down 10% earlier today, sitting back at 23 cents on the back of this study. So, and a lot of other lithium stocks were actually up. So I guess
It's a bit of that sort
is
of.
it a common thing, JD, to sort of see that on studies? There's more risk of it going down than staying or going up.
Yeah, that's right. Kind of like we spoke about with the grey there, reality starts to bite, and it's not always bad, but it just means there's less excitement, less upside, and you need to turn the thing into an actual company that makes money, and that takes a bit of risk to get there.
So these guys use the 8% NPV, guys. Tick there. NPV, $2.5 billion. All these figures are in US dollars. So I'm just going to say dollars. I don't want to say US at the start of everything. An IRR of 132%, nice and high, but we'll get into that. 11-year mine life, and they'll produce it. The life of mine annual production rate is 405,000 tonnes of 5.5% spodumene concentrate, and then an additional 123,000 tonne of 3% spodumene concentrate. Now, we'll get into what these two different spods as well, but it's a high IRR, but they state that the stage 2 capex will be funded by future cash flow. So it's another example where they're splitting up the capex into 2 stages, and I guess with the time value of money, the IRR will be a bit higher than normal because they're not deploying all the construction capital right at the start. They deploy it over 3 years instead of 1, and you can see that in those grey boxes here. So it wouldn't drop it significantly, but it's just something to keep in mind of when companies do it in stages.
Yeah,
how to look
and
at
we've
the
seen-
actual capital investment.
And we've seen a bit more of that lately. Quite a few companies come to mind. Hastings did it when the sort of capex starts to blow. You start breaking it up into a couple stages.
Yeah.
So, Matty, break it down. That phase 1 capex I saw was US 253, and then phase 2
That's paid for with the future earnings. So
Yep, of 55.
that's only 55 million. So deferred capital that'll lift the production capacity to a bit over 500,000 tonne per annum of 5.5 spod, and that extra 159,000 of the 3% concentrate. So they said there's a potential phase 3 expansion that'll be reviewed in the DFS. So there's a lot of further opportunity there. Pretty high stripping ratio, but 17.6 to 1. De Grey we've talked about was 6.6. 17.6 is getting to that high level. Remember, I think Essential, Pioneer Dome, they were about 21 or something around there. But, Develop's looking to acquire that. So you'd anticipate that when it starts getting to that higher number, that's when underground becomes a bit more beneficial than compared to open pit. So, yeah, bit on the higher end, but it's just a production risk. So I guess, 3.6 million tonne per annum plant for the ore and 17.6 times that amount for the waste, going to be a lot of dirt to move.
Big earth moving exercise.
Yeah, so look, and everyone's hot on the long-term price decks that they use. So look, the weighted average real price is assumed for each product. So that's weighted against the production rate of each year that they predict that they're selling it. For the 5.5 spod, $16.99 per tonne. So, and then $9.27 for the 3%. But so if you convert that $16.99 to see where that's sitting, if you convert that to an SC6 equivalent, that's $18.53. So I guess that's in line with Albemarle. They fully valued Liontown at $1,900 per tonne on an SC6 basis long term. So look, that's so it's spot on the money compared to what Albemarle are offering Liontown. So
yeah, let's get into that processing, Matty, because it's not very common that we've seen companies put forward that they're going to produce a SPODCon 5.5 as well as a 3. So
yeah, so it's sort of like this intermediate method. So there's a DMS circuit, so that's the dense media separation for the money miners that don't know. Dense media that's applies to the coarse grained spodumene, the easy shit to get out, but it doesn't recover the fine grained. So that's predicted to recover 67% of the spodumene for that, and that'll produce the 5.5% spodumene concentrate. Then there's a spiral circuit after this that will capture a further 11% of the finer grained material, so essentially out of the tails, to then produce a 3% spodumene product. So I guess I'm pretty sure after this, when we went to the Pilgangoora site visit, they had their tantalum recovery circuit. So that was a step in between the DMS and the flotation circuit. And it was just this big, tall spiral thing. It was another way it was how they separated out the tantalum based on the size. So I assume that spiral setup this spiral thing is similar to that. So it seems like it's an intermediate thing by instead of having the flotation circuit, which so the flotation circuits you see at Pilgangoora, Wodgina and Greenbushes. So that ensures, I guess, a higher recovery so they can capture that finer material, finer grained spodumene. But then you've got your operations like Mount Catlin, Cause, Finnis, and to my knowledge, Mount Marion, because I think they've struggled with their flotation circuit. They are essentially a DMS only. So that's why you saw a lot of poor recoveries out of Mount Catlin and Core out of Finnis in the previous financial year because they couldn't capture that finer material. So
to kind of
it's the big trade. It's a capex trade-off. Do you want to spend the money on a flotation circuit to ensure the higher recovery, or do you want to take the gamble and try and make sure you get as much out of the DMS circuit?
Yeah, and that coarser grain spodumene is more amenable to just having.
That's just DMS only. Yeah.
If you're sort of blessed with that sort of.
And seems to be like the Canadian, North American stuff. It seems like that's all amenable to DMS only, but yet to see many operating to see you get a good
sure we'll see over the next few years.
Good bloody sample size on that one. So look, transportation costs, that was another little interesting one. They stipulated $120 a tonne to ship the con. That's cost, insurance and freight all to China, but they have said that could reduce to $88 a tonne if shipped to a converter in North America. So offtake options will be looked at in the DFS. So you would think that they would want to be sending that concentrate to America. It's just there. It's not far up.
It's right there.
China's fucking ages away. Like, that'd be the most logical thing, to send it to bloody North Carolina or something. So
yeah, it's all about where the capacity downstream
true.
is.
Who knows?
That's a whole nother conversation.
The highest bidder. So look, Latin, they're driving, like one of their point they're driving is that Brazil is a jurisdiction. It's low cost for both power and labour, and also the DMS and spiral circuit and low impurities are going to help with driving down the operating costs. So I guess if you compare the capex and the opex to the peers, like looked at the latest Canaccord note today, they stated that they had a capital intensity of $760 a tonne for the spodumene concentrate. So peer average is around $1,000, so favourable there. And their OPEX was at $550 a tonne, and that sits pretty low on the cost curve with the peer averages at around $700. So look, consider that the strip ratio of 17.6 to 1, they must be pretty reliant or pretty positive they're going to have low cost of labour and power in Brazil to offset that high stripping.
And the company emphasises that they've got hydropower nearby, which supports that low power cost, and then I guess cheaper labour than you've got here in Australia.
Well, look, and even if there was issues with the strip ratio, the cost of waste movement and the labour, even if the mining cost increased by 50%, that would add an extra $160 per tonne cost per tonne of concentrate. Look, they quoted their total cash costs, which, look, that includes freight and royalties as well, at $536 that we mentioned before. So, look, if you do a weighted average of those spodumene concentrate prices over the production rates, the 5.5% and the 3%, it comes out at an average price for the con to be $1,519 a tonne. So there's still a lot of bloody wiggle room on the actual cost. So look, if the cash cost went up to $700 total per tonne, that's still 100% margin. So yeah, a lot of wiggle room on the cost at these prices that they're going to still make shitloads of money, it appears.
Yeah, and that's cash cost. So we always familiar with seeing actual cost, once everything is incorporated, being a bit higher. But if lithium prices remain where they are, it should be able to make money.
Well, you look at if you want to talk about all the costs, like they say the $55 million predicted for the stage 2 capex, that's going to come out of future cash flows. But that $55 million is an absolute piss in the ocean compared to they're predicting to make an average of $164 million free cash flow per year for the first 3 years. So that considerably covers that amount of capex. So, I don't know. Look, they're anticipating the DFS has come out first half of 2024, FID second half of 2024, and first production in second half of 2026.
Yeah, I just had one more comment on it, Matty. I noticed that they said accuracy plus or minus 35%, which, they call this a PEA. You kind of equate that to a PFS here in Australia, but 35% accuracy is not what you'd think for a PFS in Australia. That's less accurate than what a classical scoping study is in Australia. So we normally use 30% plus or minus for a scoping study. So, yeah, a bit more work to be done on that one to refine all the inputs.
Yeah, and look, from what I hear, like, it sounds like Brazil is a very good jurisdiction. Like, it's it sounds like it is a very favourable pro-mining jurisdiction where this is word on the decline.
Yep, they have
I'd say.
Absolutely.
Yeah.
Agreed.
Right, let's rip through the last few. God, I'm going to get me fucking breath back after all that. Jesus Christ, just kick me if I waffle on, LGC. 29 Metals, they've completed their retail entitlement offer. JD, I remember discussing it, saying I wonder what percentage of the retail entitlement will be taken up by the retail? How much?
Mate, we got our answer, 10%.
10%. I did say, I wonder if 50%. Ali GC, you'd be all over this shit. This is your bloody, talk about niches. How did it all work with the underwriting and everything, and the fact that there was a low retail uptake, but they still got the coin in the door? How did it all work?
Yeah, so basically the 29 Metals had a underwriting agreement with the JLMs, Macquarie and Jarden. So what happens is these guys often they can take on that underwriting risk themselves as principal, or they can sub-underwrite that risk out effectively. So in this 29 Metals scenario, the retail entitlement offer was $29 million. Only 10% of that, 2.9, was actually taken up by retail shareholders. So the balance, say $26 million, would have gone straight back to the underwriters and their sub-underwriters to take up. So almost a full fill for them.
Yeah, right. So does it say who the sub-underwriters were?
No, that's usually at the discretion of the underwriters and the company.
Okay, so we don't know if they were part of EMR or not. Or most likely not.
So with AMR, they took up essentially their pro rata position, but I think a couple of their group entities basically didn't take up their entitlement, but another EMR group entity essentially underwrote the difference in that position, so that the EMR group in total maintained their 40-something odd percent position post the entire entitlement offer.
Jeez, balls deep.
There you go.
Right, let's rip through the last bit, JD.
Yeah,
you go first, I'll go second.
Couple more stories just to touch on quickly. We saw Gina, appears to be Gina, another couple percent of Liontown's stock crossed, roughly $100 million worth. So, I mean, I got a bit of a rhetorical question. Why did she have to wait until Albemarle made their sixth bid for the company to finally decide that she's so interested in getting involved? It's kind of interesting to me. But that one's for another date, I reckon.
What do you reckon, Ali? Do you reckon she's trying to... You educated me on the scheme of arrangement. Rules.
Yeah,
but she's got some sway.
Oh, no, she's definitely got some sway, and that she doesn't seem to be slowing down by any means. So who knows, maybe she's trying to edge her way in there and keep Kathleen Valley in Australian hands. Who knows?
Yeah, we'll see. And last one to touch on, MinRes, they look all set to scoop up Bald Hill, as Maddie would say. So the terms aren't released yet, and we're keen to talk about this a bit more once it all gets revealed, how much has actually been paid and whatnot. We've seen a few notes come out from the receivers and the administrators who've been working close to this one, but we'll give it the time it deserves when a bit more info comes out.
Oh, sorry, I was on the bloody phone. I was just checking because we recorded after market to see if there was any more cross trades on Liontown that Miss Reinhardt was doing again, but none today. Doesn't appear. Last one come out yesterday at 4:10, but I can't see any. I looked pretty quick, but might eat me words there. Right, that'll do. Good, great bloody Ali GC. Thanks very much for stepping in, and that was as always fucking valuable insight.
Always adding value.
You got to pull
Head
your
of strategy.
You got to pull your weight now.
I've got to
'cause
pull
you're
my
working-
weight now.
You're getting paid for this shit. So.
Love it.
Beauty.
Couple partners to thank.
Oh, we've got 5 of the bastards and we're keeping on forgetting the order. Mate, JP Search at the start of the show, Anytime Exploration Services,
K-Drill.
SMEC Power and Technology, and our great friends at Terra Capital. Thanks very much for your support.
Cheers,
And
guys. Hoodaroo.
Hoodaroo, money miners.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.